Thank you very much for coming. As we heard, I'm going to talk a bit about blockchains here, about what they cost, about why they might be useful. I know that people have talked a lot about this topic at this conference, at other conferences. Just before I get started, to get an idea, can I do just a real quick thing? Has anybody ever used a blockchain, whether cryptocurrencies or otherwise? Excellent, few people. And from your experience, the people that put their hands up, do you find these things easy and you just get into them? No? OK, cool. Excellent. So I want to talk not only about them not particularly being easy, but maybe something else that you notice when you're using something like Ethereum or Bitcoin, that it may not actually be particularly cheap, and there's a good reason for that. So I've titled this The Costs and Benefits. We talked about, real quickly, some of the direct dollar or euro costs, but there's a lot more to it. And there are some benefits, and let's talk about those. Very quickly, who am I? I say that I'm a researcher in distributed ledger technology, or blockchain technology if you prefer, and cryptocurrencies. I do some strategy consulting for companies that are looking at this, as well as some consulting on how the markets work. I run a podcast with a gentleman in England named Simon Taylor, bi.11fs.com. Check it out if you're interested. We come out weekly, and we have lots of really interesting guests that talk about this in different ways, shape, or form. Previously, I used to work at BNP Paribas, where I set up their blockchain team within global markets. That meant everything on the trading floor, the salle de marché. So anything that would trade, I looked at whether blockchain, cryptocurrencies made sense. So you can see where cryptocurrency might come into that more and more today. I left that to set up a company called Deepactum. Unfortunately, we failed, but we learned a lot along the way, looking at this in clearing technologies. I am based here. As you can hear, I'm not originally from here. But I'm based here, so if anybody's around, I'd be happy to meet up and chat about cryptocurrencies and blockchains. So what are we going to talk about? First thing I want to get out of here, because I know it's very hard to kind of nail down what we mean, but I want to talk about when I say public blockchains or permissionless blockchains, what do I actually mean? Because I know a lot of people probably will disagree with me, which is fine. But when I start talking about them, this is kind of where I'm trying to go. And I want to talk, as I alluded to, how much these things cost. If we measure them in euros, and I want to do something with it, how much does that actually cost? I want to look at some of the things that people are using that are useful, and perhaps less useful, and perhaps somewhere in between currently, as well as some very practical, pragmatic reasons on why you might need a blockchain. And long story short, it may not be everything that people are using them for. So when I first heard about blockchains, when people started talking about it, they said, blockchains are going to revolutionize the world. Everything's going to be cheaper, faster, better, more secure, this, that, and that. Said, that may not always be the case. Really, really quickly, these things cost a lot of money to run. We're going to talk about why they cost a lot of money to run, what that particularly changes, and exactly how that's evolved over time. Because there are a lot of people out there who, if you've been following cryptocurrencies in particular, you'll notice there's a lot of discussion about one point in time. We thought this as a community. We said, Bitcoin is great. We can make micropayment services. We can do this. We can do that. Ethereum is great. It's very cheap. Everything's great and fantastic on this public database. And then we said, oh, maybe not so much. So before we get into all this, what is a blockchain? I mentioned Bitcoin. I mentioned Ethereum. A public blockchain is a bit wider than that. And I wrote something which got cut off in the bottom, but I'll tweet this out later. I try to look at this in two different axes. The first is what I call statelessness or statefulness within a blockchain. What this means is, at any given point in time, do I have everything I need to evaluate who has what? Bitcoin is a prime example, the first example of this. You take what they call unspent transaction output, a UTXO model, and you can see who has what. This is basically just each Bitcoin is a series of receipts back to when they were created by a mining process. What this means is, if you're not familiar, every 10 minutes, Bitcoin randomly selects through a process called proof of work a miner or somebody who is producing useless mathematical problems to try to win this thing. So I say useless, but they're actually quite valuable. This secures the network. If you win, you get to produce some new Bitcoins in your account and get any transaction fees. So every Bitcoin can be traced back to that particular point in its life. Now, there's other models. Ethereum is the prime model down here in my bottom right corner, sorry, bottom left corner for you, where all of this is produced in a more stateful model, meaning we can do different things with it. We have a balance, and we can program this using a very basic computer programming language that looks a lot like JavaScript, called Solidity. And this allows us to create more complex things rather than just an account balance. Now, on the other side of the spectrum, we have things that have been looked at. If any of you are familiar with a project called R3, this is a series of banks set up a group to say, well, this technology may be interesting for us. Let's look at the ways it may be interesting. One of the things they said, as opposed to Bitcoin or Ethereum, where I can just go download everything and see how much money you have, or how much money you have, or which contracts you have, they said, well, that may not work. And if anybody has used Bitcoin, they see, oh, this is great, I don't have my name attached to it. It may be a different story if you let anybody log into your online banking account and say, oh, he has 30 euros in his account. I might not let him do this transaction or something like that. Now, when you put these things all together, you get this myriad of different things, but there's this big white column right down kind of the middle of the screen where you can see I denoted public blockchains. These are things with cryptocurrencies. They have to have cryptocurrencies in order to function, or else they fall over. So other people call them permissionless blockchains. What's really important here is, regardless of whether it's stateful or stateless, everyone can see everything. Things are produced in blocks. These every 10 minutes in Bitcoin, or about every 15 seconds in Ethereum. They get pushed out to everybody that wants to see it in the network, or anybody that wants to log into it. There's no actual need to go in and say, hey, this is my name, I'm doing this. You just plug into the network like you do with the internet. So it doesn't have formalized requirements. It doesn't prohibit anybody from coming in. Blocks are only created through a process that's predetermined in this peer-to-peer network. So that's what I try to look at it as. So bear in mind when we're going through this presentation, if you're looking at how much this costs, don't extrapolate that to the right side of the screen. So how much does this stuff cost and who pays for it? I have a logarithmic chart here because if I put anything else other than that, it just goes. You'll see a lot of things in blockchains, whether it's price or anything else, tends to be logarithmic. This presentation is no different. Very, very early in the days, and even I cut this off 2 years in the life of Bitcoin, transactions were virtually zero. It didn't cost anything to send anything to anyone. Coincidentally, the price was also zero, or very close to zero. As people started to realize that Bitcoin could be valuable, we could do things like buy and sell drugs with it on Silk Road, they started to say, well, let's put more transactions in these networks to trade something that has a dollar or euro value. We could do other things that aren't illegal as well, and lots of people would use these to pay for day-to-day transactions. What happened was there were more transactions coming in, fighting for a finite space inside of a block. Now, there are good reasons for it. Whether the size of a Bitcoin or Ethereum block is correct, I don't want to get into. Lots of people have different views on, but they became more full. There was more transactions competing for the same space. What that meant was people doing the mining process said, OK, I'm going to start prioritizing transactions, and ones that pay me more, I will accept first, and ones that don't, I will ignore. As a miner, you have the power not only to write yourself a check if you produce a successful block, but to accept or reject transactions. That is very important. If I start rejecting transactions based on more than economics, or even in some cases, depending on your view, based on economics, we start to call this censorship. What we mean there is, imagine I'm trying to send an email to this gentleman in the back. Let's say my email service says, well, you cannot send it to him. That's censorship. I'm not allowed to do that. One of the key ideas behind a Bitcoin, if you go back and read through these white papers, and what happened was, we don't want to have that. We want anybody, like on the internet, like emails, to be able to send anything to anyone. It's peer-to-peer. No one should control it. One of the main issues they saw was that banks were controlling transactions. And this was a way to try to remedy that, which is coincidentally why things like Silk Road flourished. You couldn't stop a transaction, even if it was for an illegal service. Transaction fees, however, aren't the only thing that go to paying or the cost of the network. Bitcoin produces, when it first started, 50 new Bitcoin every 10 minutes, then 25 after 4 years, and now 12.5, and that'll last for another 2 years or so. Ethereum started with a kind of similar thing, producing 5 Ether every 15 seconds, or every 12 seconds back at the time. That's gone down to about 3 now. And what's really important is if we start out with, imagine a theoretical network with 100 Bitcoin, and all of a sudden I produce 50 more, that has diluted everyone or created something we call inflation in Bitcoin. This means that if you held 10% or 10 Right before this new 50, you had, great, 10% of what the total market cap was. Now you have 6.5%. This keeps going every 10 minutes until eventually you get diluted out. So this is very much like if you've raised money and your early investors get diluted out by raising more equity. This is a direct cost inside of these blockchains, and it's not something that gets talked about as much as transaction fees. But it is a very real cost and has direct implications on what happens in those transaction fees. Well, let's look at that. What I've done here since 2013 in Bitcoin and since the beginning in 2015 in Ethereum is I plotted what is my transaction fee across the top versus how many Ether or Bitcoin exists in the system. So what you can see is there are some times where the transaction fees are very high, and there's times where it's very low. The other thing was this last graph I just showed you, which is the number of Bitcoin that exist in the system, the number of Ether that exist in the system, versus how many are actually produced on that given day. And what you can see quite clearly, if we focus on Bitcoin, or the little green triangles in here, is that there was a time where the inflation was very high, up to 0.5% a day. And actually before this, it was more than that. When you're producing 0.5% of these, it's great because everybody's getting their 50 or 25 Bitcoin every 10 minutes, and there's not very many out there in the world. So that is a big, big check they're writing to themselves. That's fantastic. When they're writing a big, big check to themselves, they don't really care how much you pay them for transactions. They don't even look at it, especially when nobody's competing with it. So when there are very few transactions, when I'm writing myself a big check, I'm very happy to process your transaction for free. However, when those two things change, when there are more transactions competing and I can charge a higher fee, and that check I'm writing to myself is relatively smaller, I'm going to start prioritizing. What that means is if you move left on this graph, that transaction fee starts to come up. Now, for those that follow Bitcoin, they'll know at some point in about 100 years from now, there will be 21 million Bitcoin as a max. What means inflation will go down to 0. The question is, what happens with these transactions? I don't think that they'll go to 100% of all the Bitcoins consumed, because at least logically, not every Bitcoin will move all the time, and we probably wouldn't be happy to pay a 100% transaction fee either. But if you see something like Ethereum, which didn't ever start with quite the same high volatility, we see that same thing. So it's not purely based on capping a block size or anything like that. It is very purely based on how much inflation, how big is that check I'm writing to myself relative to the world. Now, not all cryptocurrencies, public blockchains, will charge the same amount of money. If you look at something, if I overlaid Dogecoin or one of the smaller cryptocurrencies, the fees would be dramatically lower. Now, the question is, why are they dramatically lower, which we'll get into in a minute. So, how are people using these things? Let's take a look at some of the bigger use cases. Now, this isn't all of them, but it's some of them that I picked up that have been more widely used or widely talked about. The first one is, as we've been saying, cryptocurrencies. I can use these things as money in the same way that I can use a euro, a 20-euro note, or a $10 bill to pay for things. And whatever that is, we talked about Silk Road, we talked about buying your coffee or whatever it is. And lots of people have experimented. Why don't we create a new form of money, and why don't we use this money to send it directly without needing a bank or anybody else to get in the middle? And this is incredibly interesting for a lot of people who don't like the way that current monetary systems work. Bitcoin is kind of the largest one that people have talked about. It's not the only one. I mentioned Ethereum. There's ones that focus, if you see in the top, on use cases where I want everything to be out in the public, but I want to not show everybody how much money I earn. Imagine if you were paying your employees in cryptocurrency and you told everybody how much everybody in the company earned. That could create some problems. And people have said through things like Monero or Zcash or Dash, we'd like this to be money, but we'd like to be it more private. You have other things that are looking at this idea of smart contracts, Ethereum Classic, amongst others being kind of the ones at the forefront of that. Now, Ethereum is a very large currency. A lot of these other ones are more up and coming. We'll see if they succeed. I think that there are some very interesting ideas and some very interesting technological innovations that come out of a lot of these, but remains to be seen if they catch on. Very different one people have probably heard of is something called XRP or Ripples. These are a form of currency whose stated purpose is to underlie the financial banking system. So a very different thing. And these actually don't use that proof of work system that I talked about. They use something that is very different and doesn't necessarily offer that same assurance in the same way. The other thing that people may have heard about is something called an ICO, or a token sale. There were some presentations earlier in the conference about this. This is a really new phenomenon, as everything in cryptocurrencies are, but this one is particularly new and was particularly big. The first kind of well-known one was Ethereum itself. Ethereum then became a platform that hosted a whole lot of these things. So what I started tracking was how much was raised in all the ICOs in a given month, starting in January 2016, when there were none, and then in March 2016, when $12 million was raised amongst one project. This ballooned until late last year. If you were following it, everybody probably heard the word ICO at some point in 2017, and if you didn't, you weren't listening. They raised $1.6 billion, or about 1.5 billion euros, so it's not inconsequential. This has come down dramatically because of things like securities regulations, particularly in the United States, waiting to hear some more guidance from jurisdictions, particularly in Switzerland, just next to us, as well as in France and in other countries. What's really interesting is how these things actually set up and how they're actually formed. Though this has changed, when they were originally set up, it was a very odd structure. We didn't want these things to be shares. We didn't want them to be like buying ownership in a company. We wanted them to be buying ownership in a project. This project could be a new form of money, like a Bitcoin or Ether. This is exactly how Ether was raised. The way we set these up originally, which became very easy to reproduce, was through a Swiss Stiftung, I'm pronouncing that incorrectly, but a non-profit foundation with another profitable company set aside in the United States or Germany or the United Kingdom or in France. They kept them at least nominally separate. All this money went in as a form of a donation into this Swiss Stiftung, generally, and then was doled out through tokens. We're seeing the same thing still happening, even though that structure may slightly evolve. So we have Ether, Bitcoin, whatever it is, going into this pool, and then in return, you get this new little token, new money that's been created. This has massively ballooned the amount of cryptocurrencies that have come from in the low billions of dollars about 2 years ago to now nearly $500 billion at one point late last year. The explosion of money has been massive. And this is facilitated largely in part by Ethereum actually taking off and this becoming the primary use case for a lot of 2017. Now other things have started to happen rather than just raising money. And this I've taken from FINMA, which is the regulator in Switzerland, and kind of by being the beginning of where these things happen, they've looked at and said, what are the different types of tokens we're seeing? What does that mean within a context of, is this a security, which I won't get into depth with. But the really interesting one is they highlighted this notion of utility tokens. So this is trying to use your token, not only to raise money or do anything, but to actually say it has a purpose in life. Now there's some which are highlights called payments tokens, which are money, Bitcoin or the like. They have other things they call asset tokens, which say they're investments. The ones I want to talk about are utility tokens, right down the middle. So this is, we always hear the fabled idea of, I'm going to go buy a ride on the Paris Metro, was the one we heard the other day, before it was ever built. So I'm going to sell these tickets at a 50% discount for you to ride the Metro in Paris when it's built in 5 years' time. Now, these are trying to create something that's a more intangible, esoteric idea. One of the early first use cases was something called Augur. This was very simply a betting platform. This betting platform would allow you to buy this token before it's launched, and by the way, it's still not launched fully, and use these tokens within that system. Now, these things don't necessarily work in the same way as a Bitcoin or an Ethereum. They don't validate the network. Miners don't produce them. Somebody else produces them on top as a new layer. This will become very important when we start to go back and talking about fees. A very good example, which if any of you saw the presentation, one of my favorite things that ever happened was something called CryptoKitties. These are collectibles, or think of them as art, that live on the Ethereum blockchain. So you get a little token that's unique. It's not like a Bitcoin where any Bitcoin, in theory, is supposed to be like any other Bitcoin. One Bitcoin is one Bitcoin. This is one CryptoKitty might be worth $1, one might be worth $140,000, which is what we saw in New York a couple of months ago. It's a cool game. It took off. As we heard, it melted down the Ethereum blockchain when all these ICOs were being raised and has tried to displace them. Personally, I think that this is going to be one of the very interesting new things that starts to be where Ethereum and these other smart contract platforms go to, rather than just purely utility tokens that are fungible. What is an example of those fungible ones? The basic attention token. This was something raised by a team that set up a browser called Brave. The idea is here, I don't like all these ads coming into my browser. I don't like seeing millions and millions of ads, but I still want to support people that write articles or produce stuff on the internet. So I want to create a new kind of money that works inside my browser and pay people. That's quite a cool concept. Remember, though, however, when I send money, it still costs money in Ether or whatever else I need underneath it. Another really cool idea, this was set up mid-last year and has actually become very useful for some of these ICO raises, ironically, is something called Civic. This is an identity platform. It says, you have a token, this is you. You can go to people and say, this is me. And it lives inside of a blockchain. Now, there are lots of other ways, if anybody's ever tried to use tokens or identity to say, this is me, without needing a blockchain. However, this one became somewhat universal or universally accepted amongst the projects that took it on. So I didn't need to rely on maybe the eStonia program that we'll hear about later today, or a more national program that is less digital. So what are some of the practical reasons? We talked about some of the reasons people are using it. Trading kitties, trading and paying people to use the internet, buying drugs, whatever it is, or confirming your identity. What are some of the practical reasons? I think, personally, and this is my opinion, we will find that it is censorship resistance. Again, censorship resistance is the ability for me to send that email continually to the gentleman who's now left in the back, now this lady in the back, without somebody being able to stop that email. And I know with certainty that if I meet the criteria, everything will always be sent in, whether it's legal, whether it's illegal, whether it's desired by the wider public, forget whether it's legal. There are a lot of different uses out there where people might say, I need to send money, and if I use the traditional system, it doesn't work for me. Whether that's paying in cash, which is censorship resistant, but maybe you're too far away, or whether using my bank account, which may be stopped for whatever reason. How do we measure this, and how do we measure how censorship resistant a blockchain is? I looked at this using a Herfindahl index. So basically what I did over the course of a day is I said, how many miners or how many mining pools could I find? And if I took all of them, what percentage of the blocks in that given day, Bitcoin it's 144 on average, and Ethereum it's about 18,000 in a day, how many did any particular miner get as a percentage of that? And then you look at that every single day over time. So in Bitcoin, I looked at this. When it started back in 2009, it was basically 100. There weren't very many miners. Satoshi Nakamoto, the pseudonymous creator, was mining most all of them. So more people started to come in, and you could see that a few pools started to show up and started to take lots of these things in 2012, and then very quickly that dropped. Very interestingly, the price kind of went the other way. So if you're looking at trading these things, that might be something to watch, though this isn't financial advice in any way, shape, or form. We've seen over time that this has now come back up. Coincidentally, the price has gone down. Ethereum, very different trajectory. Ethereum, we have everything back from 2015. It started much more decentralized, so this is kind of that gray line in the middle. Unlike Bitcoin, where as decentralization went up, as centralization went down, in my blackish line, and price went up, Ethereum had kind of moved in tandem in a certain points. Look around January 2016. My purple line went through the roof, as did my mining centralization. When mining is more centralized, that means that I have the potential to potentially stop transactions, which means my blockchain is less censorship resistant. We saw the price flattened or dropped somewhat. And again, these are all logarithmic lines, so they dropped a bit. That centralization went down. We saw the same thing, though not to the same extent, in early last year. Price went up from $10 to $100 and up eventually to $1,000. So did centralization. These are not particularly good things we want to see if we're trying to create a censorship-resistant platform. Now, that begs the question, how does the market value censorship resistance? Does the market value censorship resistance? Now, the short answer I have for you is they're starting to. The longer answer is no. And here's why. So if we look at transaction fees, again, these are very similar to what we saw earlier, but I have my transaction fees along the left side on my y-axis. I have now my centralization measure. So the further we go to the right, the more likely it is that your transaction will be censored, be stopped from happening. Now, if you're willing to pay a lot of money for a transaction, you would like that transaction to happen. You'd like somebody to not reverse it later, to not overwrite it. So when we move to the left, that's exactly what we see. In Bitcoin, we generally see this, though there are some people, oddly, that were willing to pay a high transaction fee back in the day, somewhere around this 0.7 mark, meaning somebody was definitely able to censor transactions if they so chose. Ethereum, as we said, is very different. Though we'd expect something that looks a bit more like Bitcoin, what we saw in Ethereum, for a variety of different reasons, was the market doesn't value this at all. Now, bear in mind the numbers are lower, meaning it's more decentralized. But what was very odd here is you could argue that this is a straight-up line that kind of curves away, or you can argue about the line that kind of rests along the x-axis that nobody ever cared. They'll just pay whatever fees you need to pay. What was very interesting is when it starts to peak up, it's not in a straight line. It curves to the right, meaning people were actually willing to pay more for transactions that could be stopped. And as you see, as we get very close to that 0.25 line, that's very critical in blockchains. That's when the possibility of a 51% attack is imminent. It doesn't mean that somebody will, but it means somebody could. So as soon as we hit 0.25, your transaction is possibly going to go through, may not, depends on how much somebody wants to stop it. And what you have to remember inside of these things is they don't happen inside of a vacuum. When we only had Bitcoin, the idea of being able to censor it was more difficult. I couldn't necessarily send you money to hack the Bitcoin blockchain without paying you in dollars or in euros or whatever else. Now, I can pay you to attack another blockchain in Bitcoin or in Ether, which means these things need to start being valued. Now, the question is, why aren't these valued? We heard about things like CryptoKitties. We heard about things like ICOs. Really, in short, people aren't using Ethereum or weren't using Ethereum for this resistance. And you say, well, why would that happen? I said they're not cheap, but how not cheap? So what I did is I looked at the cost of actually running the backbone of an Ethereum or a Bitcoin. So we hear about mining. We hear about these huge mining farms in places like China, places like Washington State, where I'm originally from. In Iceland, there's one just outside of Nantes, where people are just running these computer programs, basically burning electricity to secure a blockchain. I said, strip all that out. When you actually have a miner who wins, what are they doing, and how could you run this? And I put it on AWS, and I said, well, how much would that cost? I found out in March it would cost me $127 for the month of March to run the Bitcoin blockchain. Ethereum, let's be generous, it's about twice that. It's a little bit more complex. Let's do things like smart contracts, but it's basically a calculator that I'm running on AWS. Now, Bitcoin, in May, cost $500 million. $500 million to run something that would cost me about $200 on AWS. OK, so what about Ethereum? Obviously, this is one that's not quite cheap either. $446 million to run the Ethereum blockchain. This is the cost of all of that inflation, all those new Ether being put out in the market and somebody needs to buy them, all of those transaction fees that somebody needs to pay for things like moving kitties, buying ICOs, whatever it is. All of these things in total aggregate cost for a month are $500 million roughly. Whereas what I'm effectively doing, the transactional cost of having to maintain the blockchain could be done, if you throw away the idea of censorship resistance, for between $100 to $200, which I think for most people running a startup could find that they could fit that into their budget, given the millions and billions of dollars sitting on top of these blockchains. So, again, why pay this big difference? Is it useless? Are we just playing a game? Maybe. But if you're looking at this thing as censorship resistance, how much value is it worth to me to know that my transaction will always make it through? It could be 100% of your value. It could be that you know if you're doing your transaction, it won't go through. So the question is, of all these use cases we've seen, which ones are actually useful? The argument I'd make is paying for the public blockchain only really makes sense when censorship is a major concern. When I'm worried that either a powerful company or a powerful government will stop it. And it's no coincidence that a lot of people that have started looking at things like Bitcoin have started of the vein of, I believe the government is doing something that I need to protect myself against. And a lot of people have looked at the early projects in this. However, things like kitties, although I think they're fantastic and cool, may not always fit into this. Things like being able to pay somebody for writing an article online is great. But if I need to pay $20 to send a 30-cent tip to somebody, that may not make sense. So when you start to look at using these things, think about, what am I trying to do? What am I trying to prevent? Is this the best platform? It may not be a blockchain at all. It may not be a public blockchain. Who knows? There are lots of interesting options, and it won't always fit on this. But when you do need that censorship resistance, you'll be quite happy to pay these high fees that need to happen if that transaction is important enough to you. So that's the end of my talk. I left some time for questions if anybody has any. Otherwise, as I said, I'm here, happy to have a chat with you outside afterwards.